Louie here. I wanted to read you this good article, I thought, from Seeking Alpha. COVID-19 equals hyperinflation. As you know, we've had some bullish moves in all the metals here recently. I'm going to skip that part of it. Let's see, they're talking about the flurry of buyers after the 10:30 a.m. Pacific Standard Time close that drove the market to close up to 1586 in gold. This is a couple days before the move. With regard to some of the activity on the COMEX gold options, gold was trading in a strong market when it looked like technically it was going to take out the highs. The volume expanded to 104,000 options compared to the 37,000, which is typically the number of options traded. Most of the activity was on the October calls with a strike price of 1650 to 1750 and 1775. It has an open rising interest by about 16,000 contracts. There was also an additional 8,000 contracts purchased for March. The smart money seems to be looking for a rise in the price of gold further out. The COMEX open interest took a sudden jump to 17,792, the first bullish sign since January of this year. For the past week, gold has been giving us mixed signals, trading around the weekly average price, with supply being offered up into that 1580 to 1585 area. I am looking at a point of note that I don't believe we have seen the economic implications of the coronavirus affecting the global economy yet. The action in the price of gold has been subdued on the upside and the downside. Considering the short open interest in the derivatives markets, it was expected that the price of gold would have a deeper correction than we have seen in the past few weeks. So there were a lot of shorts, apparently. We have seen about a $50 to $60 correction since the high at 1613. No longer true. This article was a couple days ago. Was made after the Iran missile attack on Iraq. The secondary high is 1598. Which we reached on the first news that came out about the coronavirus. I was surprised that it did not follow through, and instead it reverted back down below the daily, weekly, and monthly mean. It made a low of 1551. We expected the low to be in that 1550 to 1560 area. It was in the vicinity to complete this pattern, and it reverted right back up past the daily, weekly, and monthly average price. I think the market is looking for a direction. There is still uncertainty the global economic effect of the coronavirus, particularly in Asia and Australia. We have not yet seen any economic deterioration, at least in the government figures. If the second largest economy is at a standstill, eliminating the ability to export commodities and products, it must affect the trading partners on a global basis. Clearly, in the short term, it should have a deflationary effect. When the reality sets in that there are no supplies to replace what was exported by China, the commodities, goods and services, we are going to find ourselves with an incredible shortage on a global scale that we have never seen before. This is potentially a historic event that could be a black swan, that could shift the paradigm of supply and demand globally of all of these products related to China. The coronavirus could cause a massive global economic upheaval that will lead to a flight of capital, hyperinflation, and gold and silver will rise significantly, offering incredible trading opportunities. Based on the price of gold rising from 1551 to 1560, we now have a harmonic relationship at the 1571 level that seems to coincide with the daily, weekly, and monthly average of 1578. They appear potentially to be areas where you might want to cover any short positions or hedges or short derivatives. The movement may adjust the price of gold to the risks related to the coronavirus and will exacerbate some of the other economic factors that seem to be underplayed, such as the government deficit breaking for the first time $1 trillion, even as the world debt levels continue to skyrocket around the world. I believe that we have very few choices, and the path of least resistance is to continue to print money at levels that we have never seen before, especially if these inflationary risk triggers unfold. Central banks will probably continue to reduce interest rates, and they may have to do massive quantitative easing in different forms. I am looking for the opportunity to add my long-term view that the annual target for 2020 is 1655 to 1800 in gold, and I don't believe we have yet completed that initial target. Getting very close to the low end of his prediction. And you have to give props to somebody who a few days before the move indicated it was coming. I want to review the monthly and yearly indicators that we are using to trade gold. Gold closed at 1586 on Friday, February 14th. The monthly VCPMI is at 1578, so the market closing above that level has activated a bullish price momentum. The VCPMI average price is a 50-50 standard deviation that the market will go up or down. To use the VCPMI, we wait for the highest probability trades, either at an extreme level above or below the mean. All right, I won't get too much into that. The low of this move was 1302 on May 30, 2019. It was not quite coming down into the annual expected buy level of 1268, which we published on September 28, 2019. The annual numbers were published to give us an idea about the structure of the market for a year starting on September 28, 2019. We use daily, weekly, and monthly indicators to identify harmonic relationships between them as the price goes to the same level for all three trends. When all three trends match, it provides the highest probability trades. It identifies when a reversion to the mean is highly likely, especially when all three trends match. The market closing above the average monthly price of 1578 means that we are coming into the rest of this month with a bullish price momentum. This activates the monthly target above the mean of 1630, sell number 1. For the remainder of February, the sell number 1 level has a 90% probability that the market will revert from there back to the mean. So he's predicting it goes back down. If it does not activate a short signal after confirmation, the next level above, the sell 2 level, activates a 95% probability of a reversion to the mean if it is triggered. If gold goes down to the next level below 1578, it would neutralize the bullish price momentum to neutral. It would also activate the level below buy 1 at 1536 on a second close. The buy 2 level is 1548. We can expect that, based on the artificial intelligence of the VCPMI and gold closing above the monthly average price, it activates the sell 1 level of 1630 to the sell 2 level of 1672 as targets. So he's predicting it'll move between 1630 and 1672. As we come into the next week and the balance of this month, if gold closes below 1578, it would negate this bullish to neutral, and another close below activates the bearish price momentum. Okay? And let's see, we go on and on and on. And conclusion. Based on the artificial intelligence of the VCPMI, the monthly and yearly indicators are in a bullish price momentum. The monthly indicator gives you a protective stop on the close below 1578, which would negate this bullish to neutral. If the market closes below 1578, it activates the monthly targets of 1536, 1584. Before I make any further interpretations, I want to see how this price reacts from where we are right now. We are in a neutral to bullish position, and a close below 1578 could activate the monthly level below 1536 or to 1484. We may find more buyers to bring the price up to 1619, yes, which was the previous target made on January 8th after the Iran missile attack on the U.S. base in Iraq, in which case the market could reach the annual target of 1655. If we get a spike move up into this price, I strongly suggest that you lock in your profits and reduce your position or hedge, since the annual, monthly, and weekly and daily targets will all have been completed. The price action is the element that activates the VCPMI trigger points, which gives us a methodical, scientific way to trade the market with very specific criteria. Okay, and we'll have to put this author's name in here at the very end. So he is saying that you could reach 1655, and that would be a sell or at a minimum, go to neutral position. Seems like we are marching steadily higher to that number. This great article, sorry for all the detail in here, but some of you might find this interesting, and I will put the link. This is from Equity Management Academy. All right, and I'm not sure. This is on Seeking Alpha is the website, and no, I think that may be an ad for Equity Management Academy. Who is the author of this article? Hold on. Yes, Equity Management Academy is the author. We've got some comments down here. Thank you. Starting to feel like I'm the only one expecting this. Americans had been switching import from China to other parts of the world for more than 2 years. Have tried. Let's see. Nothing about hyperinflation. Did you not read the article? When the reality sets in that there are no supplies to replace what was exported by China, from commodities to goods and services, we are going to find ourselves with an incredible shortage on a global scale that we have never seen before. Okay, look for this. I mean, the Walmarts and the dollar stores, the shelves are going to start to empty out here, and some of the components of things that we rely upon are going to go into back order. He says that will cause hyperinflation in these commodities, I believe. So I'll leave you to figure out exactly what that could translate into. Maybe many commodities could begin to go up in price. I see no inflation in Canada, no shortage of Chinese products. Well, you have to give it some time. I always find it strange that people say the stock market, there's been no reported decreases in GDP or any of the metrics that are reported on CNBC, but those are all reported in arrears. So this is unfolding in such a real-time level that you won't actually see these numbers hit, the statistics for quite a while still. But it's definitely coming. You can't shut down a significant number of factories in China and expect the production line to continue. A lot of stuff is made in China. It's not about hyperinflation. It's about propping the market bubble. Blame it on the corona or whatever, but if you're looking for logic, the explanation is that the virus negated the treaty deal yet to come. All right, somebody asked if stocks are hyperinflated. All right, well, that's enough of the comments. But anyway, what are your thoughts on this article? I thought it was a really good article. A lot of technical data in here, but he predicted the jump in gold, which happened just a couple days later. And he is saying that inflation in the production chain is coming, and that will also be positive for gold. No mention of silver in this article. All right, guys, let me know your thoughts, and thanks for tuning in. Bye.